Welcome to the STR Data Lab.
Hello and welcome to the latest edition of the STR Data Lab. I'm Jamie Lane, Chief Economist at AirDNA, and I'm joined today again by my trusty co-host, Scott Sage, our VP of Marketing. Welcome.
Jamie, great to see you again.
Good to see you too. So we're sitting here in mid-November. We're going to talk a little bit about October performance, but it's kind of been a wild month. And I say here in Georgia, and maybe I'm just way more exposed to election. But it was maybe and some up and downs and in terms of who expected to win. And then we're going to have a Trump presidency coming up. I suspect most of our about half our listeners are excited, half are not excited, given
On what part of the country you're in, that
based on the country. And yeah, so maybe we'll talk a little bit about the results of the election and what that might mean for short-term rentals going forward. But maybe some friendly banter to begin with. Like, how's your past few weeks been?
Yeah, not much has been going on, right? Pretty mellow last couple of weeks. Yeah, this happens every 4 years, obviously, and I think it would be a great talking point to understand, Jamie, how we're thinking about the impact of the election, number one, on the short-term rental industry, and then what a Trump presidency might mean for the short-term rental industry. It could be speculative at this point, but we're already seeing some impacts across the crypto markets, for example, or even just the equities markets are responding to the election results in the subsequent 2 weeks post-election.
Yeah, I suspect you're a big crypto holder. Am I right?
I wish I could tell you I had a large portfolio of Bitcoin, but that is not true. I chose to invest in real assets, which is why we're talking today.
Ouch. Yeah.
Nah, I believe there's a place for it. I allocate a small portion of my assets towards Bitcoin.
Yeah. You're better than me. I don't have any. And sometimes I feel like it's a great decision. And sometimes I feel like it's a terrible decision. But right now, no exposure.
Fair to have a little FOMO, but why don't we jump into the STR data? We're not a Bitcoin podcast. And so maybe the focus, one key takeaway from the October US market data is strong occupancy growth.
Yeah. So, and we start with just like occupancy, obviously, is the intersection between supply and demand. Demand has been very stable over the past year, roughly, and growing year to date up 7%. And there's been some ups and downs, a lot of that having to do with calendar shift, like when Easter is, when Labor Day is. We've talked ad nauseum about that over the past year. But like 7% and it came in October, 7.5. So pretty consistent with what we've seen this year. And really what's been driving either occupancy increases or decreases is what's been happening on supply. Because that we've seen and sort of start above 7% at the beginning of the year and then now dip down and we're sitting in October, it was only up 4.5%, which leads us to and starting the year with occupancy declines and now ending the year with occupancy increases. And what's great and when we started the year is like, that's really what we predicted things were going to be coming in at, that we are going to see supply growth sort of decelerate throughout the year. And that's exactly what we've been seeing.
That's exactly right. I mean, I think that's been the forecast and somewhat the hope of some STR hosts and operators, right? But you look at the economic factors driving this, likely due to some of the high mortgage rates we've seen over the past couple of years, dating back to 2022, which have slowed new listings. It's compressed margins for operators, and so you may see some go to the sidelines or convert an STR into a long-term rental, or maybe even sell. And so the growth of new listings has slowed, which is making a strong impact on occupancy. Jamie, the other takeaway and just us skimming of this data is all metrics that we're tracking in October saw increase. So RevPar, available listings, total demand nights, occupancy, ADR, repeat rent index, and nights booked all saw increases year over year, October 2024 compared to 23.
We're in a growth sector. What can I say? And And a lot of them are very correlated, right? Like you're not going to see 80, you're probably not going to see ADR gains when occupancies are decreasing. Like we saw that last year and the year before. And listings are generally going to go up unless you're in a major recession, like what we saw during COVID. But the sort of underlying driver right now is the economy. And every month I like to talk about jobs. We only saw 12,000 jobs added in October. And I'll just caveat that by, and a lot of it was hurricane displacement. So the week that the BLS actually surveys employers was the week right after the hurricane. So a lot of people out of work. And it's not necessarily that you got fired from your job. It's like they're just asking you, did you work last week? And if like you had evacuated and like you were off because of the hurricane, like you wouldn't count as employed during that time period. And we also had a high profile strike by Boeing workers that was now past us or is past us, but that also impacted it. So the other sort of thing to keep an eye on is unemployment, which held steady 4.1% and is very low historically. And then the other sort of big news over the past couple of weeks was that the Federal Reserve did cut interest rates, short-term interest rates, by another 25 basis points. That was largely expected due to the CPI coming in, inflation continued to come down. So overall for the economy, I'm still feeling pretty good. And I think we're seeing that in the overall demand picture for short-term rentals that is continuing to expand.
And Jamie, help me make the connection between the jobs report, unemployment rate, and my performance as a STR host.
Yeah. And it goes back, and we've done a lot of research on this over the years. It's like, what are the factors that lead people to continue to travel? So the biggest factors are, do I have a job? And am I making more money in real terms? Is my wage growth higher than overall inflation growth? Like, is the income that I have in my pocket that shows up in my bank account every month, is it greater than expenses sort of coming out? So, and all those factors, like we're fully employed on the overall economy. Like you see that in the unemployment rate, and we are finally now and seeing real wage growth, and the wages that people are getting are growing faster than overall expenses across the board.
Thus, people in theory have more discretionary income. And where do people like to spend discretionary income? On travel.
Yeah. And those are other factors you look at, like how people are spending their money. Are they spending more on goods, spending more on services, spending more on travel? And a broad trend that we've talked about over the years is that people are wanting to spend more on experiences, wanting to spend more on travel relative to the other things. And you actually see that in tracking the economy. Like there's clear pullback and like the stock and spending and revenues that like a Home Depot or an Amazon or a Target, Walmart are seeing. And then you look on the flip side of like an Airbnb, Booking, Expedia, Marriott, Hilton, and the growth rates that they're seeing. So we clearly see strong growth for travel, and that's a net benefit for short-term rental hosts.
And then how should we be thinking about this second rate cut within the past basically month and its impact on our industry?
Yeah. So the hope is that interest rates are going to be coming down for the and what we have to pay for new mortgages, right? Like because and as most of our listeners are going to know, if that interest rate comes down, that means your monthly payment on that property is going to be less because most of us are taking out a mortgage or a loan to go along with our short term rental investment. There should be and is over time a loose relationship between what the Fed's overnight rate is, the Fed funds rate, and what the long term rates are for 30-year fixed rate mortgages. Though it's a loose relationship. There's a lot of factors that go into it. And right now, what we're seeing is that inflation expectations are starting to tick up a bit. So we've gone from 10% inflation like 2 years ago. We now come down. We're at roughly 2.5%. And now with the election of Donald Trump, and I think really most importantly, that Republicans are going to hold both sides of the House, Congress, the House and Senate, that there is going to be an increase in government spending going forward, and that will lead to higher inflation in the years to come. That then puts upward pressure on the 10-year Treasury, which has a clear relationship with 30-year fixed rate mortgages. So while short-term rates are coming down, long-term rates have been going up. And what was so interesting to see is that they went up with the percent chance of Donald Trump becoming president and the Republicans sort of taking control of the government. And they actually went down a bit when Vice President Harris's polling numbers went up. So there's this expectation here, and then we got past the election, and they've been up since then. So, and as we know, higher interest rates do have a knock-on effect of supply growth. So if interest rates are higher, it makes it harder for investors to sort of justify the expense of new investment. And with interest rates maybe higher for longer, that has sort of ratcheted down our expectation of supply growth over the years to come.
And we've seen those downstream consequences in what we started the show talking about, which is the slowing of supply growth.
Yeah, and you see it. And one of my favorite numbers, and if and our listeners sort of look at our monthly write-ups, and we talk about it pretty often, is how many new listings do we see come in any given month? And we're running right now just under 60,000 new listings coming into the U.S. Each month, and that's down from, let's say, going back to 2023 or 2024. Around this time, we were seeing anywhere from 65 to 70 or 75,000 new listings being added. So down significantly, and that's impacting the supply growth that we're seeing.
How much of that, Jamie, do you think is influenced by regulation?
And clearly, regulation is a piece of it. And we can see that when we look at supply growth by location type. When we actually look at urban locations today, we're seeing supply growth of negative 0.6%. So supply is actually falling in urban areas in the US today. There's some cities that are easy to call out in terms of regulation impact. Others, and there's other factors like New York, supply is clearly decreasing because of regulation. There's cities like San Francisco where maybe there's not new regulation, but sort of other factors playing into, and still a relative weak overall demand picture in San Francisco that has led to properties pulling back. You've got supply falling in Maui. You've got supply falling in Coachella Valley, which maybe there is a clear regulation impact, not an urban area, but still being impacted by regulation. We've seen in the past supply falling in Dallas, which saw new regulation come in. So yeah, there's definitely a regulation piece to that supply growth picture. But even in areas that you don't typically see regulation, like coastal or mountain markets, which generally the economies are sort of highly impacted by the supply of short-term rentals. And there's regulation, but it's generally just like a registration and permit type piece. We're seeing supply growth now of only 2% growth, 2.5% growth in mountain lake markets, and only 4.5% growth in coastal markets. So that's where you see other factors like investability being probably the main factor there.
Right. And you contrast that with the growth rate of small city and rural, nearly 13% year over year change in available listings. How much of that is investability, limited regulation, or pure travel preferences and supply meeting demand?
All of the above. Uh,
Option D, all of the above.
Yeah. Strong performance is a big piece of investability. So how much revenue these are properties are earning relative to the home values, relatively low home values compared to other type of markets like mountains, beach, or in urban areas. And regulation clearly a component too of just and the numbers pencil and there's not regulation, like let's go.
All right. Well, we spent some time looking forward. Now let's continue to review October here. So we talked about the supply trends. That's one part of the equation. We also saw demand surge, especially around the holiday season. So demand surged 7.5% year over year. Possibly, Jamie, here an uptick driven by a combination of both current demand and strong bookings for the approaching holiday season.
Yeah. So nights booked in October up 12.5%. That is a bit higher than we have been seeing. And so in nights booked, when we track that for October, that is a measure of nights booked during October for future stays. So it's not necessary. Some of those stays are obviously happening in October, but most of those stays are actually happening for future dates. And it sort of gets into what we're seeing. Maybe we'll talk a little bit about, go ahead and talk about holiday pacing because that's where those nights are being booked for. So we are seeing demand down slightly for and relative to last year for Thanksgiving, given the calendar shift and the sort of late timing of Thanksgiving. But we're seeing very strong growth for sort of the Christmas New Year's holiday, and it's really interesting to see because of like this is almost entirely because of the calendar, and I feel like we talk about the calendar all the
It's the
time.
central theme of this show.
Yeah, but this year we've got both Christmas and New Year's happening on a Wednesday, and typically, and it's not middle of the week. And when it's on a Monday or Tuesday, like it'll sort of blend in with the weekend before. When it's on a Thursday, Friday, it'll sort of blend in with the weekend after. And now we see essentially 2 full weeks being occupied by the Christmas New Year's holiday. So, quick question for you: Are you doing taking up the week of Christmas? Are you taking a week off of New Year's? Or are you taking both?
Jamie, I would love to have my laptop closed from December 23rd to January 5th. I will do my best to honor probably December 23rd through about the 30th, and then maybe in and out until the 5th.
Yeah.
What about you?
I'm probably pretty similar. Like I'm gonna probably take off the week of Christmas and then that second week, like it's gonna be a bit rough because the kids are off, but still trying to get some work done. I think we've got the oldest in a camp, but there'll be some uncertainty there on how much work gets done at any given time. But maybe I'll just take it as a week free of a lot of meetings.
Yeah, a week free of meetings with me, that's for sure.
Yeah. What we're seeing though is like a lot of people are taking both, like, or I'm doing one of each. So like last year, and when we look at how many days of like above average demand, like it was like 11 days that were strong demand during the holiday season. Now we're seeing 15 full days of stronger holiday season demand. So and it pushes much further into January than we saw and starts and roughly the same. So that sort of January 5th date, New Year's being on a Wednesday instead of a Monday, is clearly pushing more people to take that full second week off. And typically January is a pretty weak time for demand. So maybe gives and when we talk about January performance and next February, and we're going to be probably talking about this date shift again.
So I guess that data answers your question that the majority of folks are taking 2 weeks off. So that's good for employees, good for Airbnb hosts, not great for employers.
And also something to and as you're sort of setting rates, like if you haven't already got booked for the holidays, make sure you're not just looking at December through New Year's, but taking into account that full first week of January that and you could be seeing elevated demand much further into January than you saw maybe last year.
Well, let's go there. Let's talk about host setting rates because as we looked at October, we saw hosts regain control over pricing with ADR rise 5.5% year over year in October.
Yep. And it's important to sort of help people understand what that 5.5% means. Because that and as we report it in the app, it's average guest paid rate, what guests are paying to stay in that market on any given night or throughout that month. And there's two components of that. There's one, it's sort of mix of units being sold. And then two is how much are hosts actually raising rates compared to last year. And so there we saw on the average host increase rates by 2.5% over last year, sort of and controlling and looking at the same properties on a year over year basis. And then we saw half of that sort of 5.5% come from and sort of the mix of units changing. So we still continue to see guests preferring larger, nicer homes with more amenities, and that pushing the overall guest paid rate higher than just what we see the average host raising their rates.
Jamie, I mean, so far we've talked about a lot of positive growth signals for the operating and host side. Final question here or topic is a twofold. One, how do you forecast us ending the year? So as you look into December, how will we finish compared to 2023? And then can you give a sneak preview of our 2025 outlook report set to come out in mid-December?
Yeah. And and I know you hate when I do this, but I'm just gonna give some caveats out there because we've talked a lot of positive stuff, and it's not all positive. And when we're talking about sort of national averages, and there's always people performing at or better or at or below. And so, and location types that are seeing some of the strongest growth in supply, and small city rural actually saw real rates decline. So repeat rents and hosts lowered rates across the board in those location types, and almost no occupancy growth in mountain or coastal markets, well below average there. So you got to keep in mind and not compare yourself versus the nation, but look in and see what's happening at the market level, because there were quite a few markets that did see RevPar declines. There were quite a few markets that saw occupancy declines. So I don't want to make listeners feel too bad, and if they're not seeing the gains that we talked about nationally, because it can vary and pretty significantly across the board.
Well, we got 20 minutes in before you gave a caveat, so we're making progress.
Yeah. So talking a little bit about expectations for full year, and we're through October now. So last 3 months, last 2 months aren't going to change things much, and especially since November and December are generally lower overall demand and revenue periods. So roughly more of the same is the expectation. We have seen sort of hurricane impacts play out, stronger occupancy in some of those markets now impacted by the hurricane from displaced residents. And that is one of the sort of impacts we generally see from hurricanes, is like in the moment, you see people avoid that area, travelers not wanting to come in. But then in the aftermath, like short-term rentals are used for temporary housing, and we typically see occupancy increases. I think what's really nice to see, maybe just on a personal level, is like we're not seeing a corresponding increase in rates. So people aren't gouging like they do see, and typically short-term rentals as a option, and like everyone's just happy to get demand and help out their neighbors in the aftermath of these storms. On the demand side, we're roughly averaging 7% for the back half of the year. A little lower in November. I expect to see a slight occupancy decrease. A little better in December. Expect to see occupancy increases. And then as we look out into 2025, so far in January pacing good, and then we start to get into some calendar shifts. I won't bore you with talking with Easter movements and things like that right now, but generally we're seeing positive signs for 2025. And with supply growth continuing to decelerate, I think that could have some really positive factors for occupancy and ADR in 2025, given that, and that's going to be the biggest sort of shift you see in our outlook, in a theme throughout, is the expectation of lower interest rates just isn't come to fruition. And with that, and we're just not seeing the reacceleration in supply growth that we had been expecting.
Great preview and teaser for the outlook report coming next month.
Awesome. And yeah, so for listeners, I'm going to be at DARM in December, the Data and Revenue Management Conference. So if you're going to be there down in Destin, I'll be there all 3 days. Going to be presenting on 2 panels. Would love to meet. Feel free to reach out if you want to get together and talk data.
Can't miss event. Well,
Yeah.
Jamie, it was great to recap October. Looking forward to the year in review coming up shortly, and have a happy Thanksgiving.
Awesome. Thanks, Scott. Happy Thanksgiving.